Oil prices have remained soft for the last 9 months on fears of a global slowdown. The recent crisis in the global banking sector has sharply accelerated the oil slide on fears of a squeeze in demand. Prices of Brent crude and WTI crude have dropped to 15-month lows below $75 per barrel and $70 per barrel. In the near term, analysts believe that crude oil prices could recover due to firm Chinese demand and planned production cuts by OPEC+. However, a sustained uptrend still depends on improvement in the global growth outlook.
With recovery in demand from China, a shortage on the Russian oil, and a planned production cut from the OPEC could offer some respite to the prices. And we are eyeing $64 in Brent and $61 in WTI to act as a key support to further cap the damage. And for a short-term reversal, we need a decisive close above $90 in Brent and $83 in WTI. However, for a sustained recovery, the key factor would be the improvement in the global economic outlook in the coming months.
Meanwhile, despite the fall in crude prices, analysts believe that oil marketing companies or OMCs still remain a few quarters away from recouping the losses on their marketing margins. Those at JM Financial say that optimism for OMCs is contingent on crude sustaining below $75 to $80 per BBL and government compensation. The brokerage has buy ratings on HPCL and BPCL given their attractive valuations and a hold rating on Indian oil. That apart, experts say that the reduction in windfall tax on locally produced crude oil will likely benefit both oil producers and standalone refiners.
We expect the outlook for the three OMCs to be weaker than the previous year in terms of profitability. Even if the oil prices have now come down, these companies incurred heavy marketing losses in first half, which will bring down the overall earnings for 2023. For upstream companies, sustained higher crude oil prices and gas prices can result in better profitability for the upstream companies. We expect the companies to invest heavily in capex for their continuing efforts to expand production. Our two stock picks from this space are ONGC and Oil India.
On the bourses, barring Reliance Industries, shares of BPCL, HPCL, Indian Oil Corporation and Chennai Petroleum have surged up to 18% so far this year. In comparison, the BSE Sensex has declined 5% during this period. As regard today, all eyes will be on the US Federal Reserve's interest rate decision. In view of the banking crisis, market participants remain divided over the likely quantum of rate hike that the central bank could deliver today.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.